So like Gilbert said, I'm Kyle Frank. I'm the VP Exploration and Corporate Development for Troilus. I have a geology and technical background, and I've been with Troilus for about 4 years now. So Troilus is one of the largest developing projects in North America, gold, copper, and silver. So four main points I'd like to touch on today are the scale, the jurisdiction, the timeline, and the team. So these four things really set Troilus apart from a lot of our competitors. So a bit about the history. This was already touched on a little bit, but this is a past producing open pit project in Quebec, Canada. So produced 2 million ounces of gold and 70,000 tons of copper through 14 years of operation. The mine shut down in 2010 and moved into care and maintenance. So the company at the time, Inmet, was building Cobre Panama. They were investing a lot of capital into building base metal projects globally, and therefore didn't invest into drilling and expanding the resource at Troilus. So when the resource was exhausted, they chose to move into care and maintenance as opposed to doing an extensive drill program. So they're left behind an opportunity for another company to come in. We saw that opportunity, and I'll just skip ahead to our timeline. We saw that opportunity and purchased this project privately in 2017. We went public in 2018, raised money in the market, started drilling, and got to work. So through the last 5 to 6 years, we've done an extensive drilling program, one of the largest in Canada, drilling over 300,000 meters. We have outlined one of the largest developing gold copper resources in North America at 13 million ounces equivalent. We've published a full feasibility study in May of 2024. We're well underway in permitting, and we're looking ahead to project financing and putting this project back into construction, hopefully breaking ground by the end of 2026, full-scale production by 2029. Again, kind of looking back to where we came from and where we are now, the image on the top shows the resource that we inherited at the time of acquisition. This was thought to be a 2 million ounce underground target that was below one of the old open pits. We started drilling, very quickly found resources along strike, in the hanging wall, basically in every direction around the old pits that you can imagine, as well as discovered 2 new resources. So in total of 4 pits now, the 2 past producing pits and 2 new discoveries. And on the bottom, you can see the resource modeling that exists today after all of that drilling. And really, it's not like we reinvented the wheel here. It was just about allocating meters required for this property to find the resources that were left behind from the past producer. So a bit about our location. We are in Quebec, Canada, one of the best jurisdictions in the world to work in mining. I believe we generally rank around 5th in the global rankings. We have excellent government support. I'll talk about our capital structure, but the government is a shareholder of our business. We're located about 2 hours from the town of Chibougamau. Chibougamau is a mining, logging, and resource town. It has all the amenities that are required to run a mine, as this is a past producing project. This operated before. We have a lot of support from the local communities, including the local First Nations who have had a working agreement with this project previously. So if we take a closer look at where we're located on a geological perspective, we are in the Frôtet-Evans Greenstone Belt. This is an Archean greenstone belt, very similar to the Abitibi. If you follow mining in Canada, obviously the Abitibi is one of the richest gold environments in the world and has numerous successful past and current producing gold mines. So we are in a very similar environment. These are very similar rocks, similar age, similar structure. Historically less explored. There's more till coverage. It's harder to make discoveries. There's been a lot less work and a lot less drilling. So that's left behind a great opportunity in the belt. An even closer look now, I mentioned that there are 2 past producing open pits. You can see those in the bottom right of the picture. They are filled with water, and I will talk about our dewatering plan. We are actively dewatering those pits right now. We have a 500 square kilometer property. We have obviously the mine site itself, but we also explore each field season looking for other discoveries. We believe the entire property is prospective for high-grade gold. So one of the aspects that really sets us apart is part of the jurisdiction and partially that we are a brownfield site. So we've inherited a lot of old infrastructure from the past producing mine that gives us a head start on our CapEx. So we value this inherited infrastructure at 500 million US, which includes 60-kilometer power line right to site, a 50-megawatt substation. So we are connected to Quebec hydroelectric grid power already. We have roads to site, 44 kilometers of roads, and probably most importantly, a fully permitted and operational tailings facility that is below kind of the pictures in the bottom right part of the photograph. So as mentioned, we published a feasibility study in May of 2024. This is really a snapshot in time. This was done at a base case of 1975 gold. So this outlined a 22-year mine life, averaging over 300,000 ounces equivalent per year production, a capex of 1.1 billion, and an all-in sustaining cost per ounce of about $1,100 US. So if we look at our economic sensitivities to this feasibility study, again, our base case was at 1975 gold, $4.05 copper, and $23 an ounce silver. Several months ago, we published what we thought was a blue sky scenario in a $3,000 gold environment, a $5 copper environment, and a $30 silver environment. And obviously this morning, we are exceeding those at spot price in every category. So if we look at our blue sky scenario, which really is our spot case right now, this is an after-tax project of 2.8 billion, 28% IRR, and less than 4-year payback. And remember, that's a long mine life, large scale, one of the biggest developing projects in Canada. Think analogous to Malartic or to Detour, one of the, these are the most profitable mines that we see in North America. So there's a significant cash or significant capex up front, and once you get that paid back under 4 years in today's market conditions, this becomes a cash flow machine. At our base case of 1975 gold, very conservative, this will produce 150 million of free cash flow every year for a total of 2.2 billion over the life of mine. So at our blue sky or current spot price, that's over 300 million in free cash flow per year. So if we look at our project costs, we really tried to make this feasibility study as realistic as possible. We wanted to take this to the lenders to finance this project. This was not a market promotion feasibility study. This was meant to use real-time numbers. All of our costs are post-inflation, they're post-COVID. Again, this project came out a year ago, so it is still fairly recent. You can see on the right, we are of the recent emerging producing mines in Canada, we are the most expensive per ounce. We really see that as a benefit to this study. It shows that it's realistic. If you look compared to the current producers, we were one of the top producers in Canada and at one of the lowest all-in sustaining costs. So this is gold does drive this project, but it is very important to consider all 3 metals that we will produce. So 83% of the project is gold, but 15% is copper. Copper is becoming extremely important at Troilus, especially when we start talking about project financing, which I'll get into next. And we do also have 2% of the project as silver. So when I talk about equivalent ounces, that's the breakdown of the 3 metals. So here's a look at our production profile over the life of the mine. You can see that this really ramps up by year 5, 6, 7. Those are the big high-grade years of the mine life, producing the most ounces. but averaging again over 300,000 ounces equivalent per year. So over the life of mine, this project will produce over 5 million ounces of gold, just under 400 million pounds of copper, and just under 10 million ounces of silver. So how are we going to finance this project? Obviously, 1.1 billion is reasonable for a project of this size. We're looking at a 50,000 ton per day throughput in our feasibility study, but still a big number nonetheless. So because of our clean copper concentrate that the project will produce, coming out of the mill, it's a very simple circuit producing gold bars as 30% of the gold, and the rest of the gold reporting to a gold, copper, silver concentrate, which has very low impurities and is very attractive for off-takers. We've since used that to attract letters of intent from export credit agencies in both Canada and Europe. So late last year, we received letters of intent from 4 export credit agencies for up to 1.3 billion in senior secured debt. A few weeks ago, we turned those letters of intent into a formal mandate for up to 700 million in debt. So the mandate outlines 3 lead arrangers: Export Development Canada, which is the Canadian Export Credit Agency, and Société Générale out of Paris, and KfW from Germany. And sitting below those are the export credit agencies, Canadian, German, Finnish, and Swedish export credit agencies, which actually guarantee the money. And all of that is tied to offtake of the concentrate. The Europeans are looking to secure concentrate for their smelters, keep them fed, and keep them operating. So on top of that, that's 700 million of the 1.1. We're also looking at opportunities to potentially put a stream or royalty on this property for non-dilutive financing as well. Obviously, silver is a great place to start. Silver is 2% of the project. It's about 1% of the revenue. It's an easy place to start with looking at streams or royalties. And then the last component would, of course, be equity, and we're hoping to limit that to about 150 million. So this will be one of the largest recent project financing in the Americas. You can see all of the recent project financings that were done, kind of in the 300 million range, and of course we would be up to 700 million, depending on the breakdown of equity, royalty stream, and debt that we would ultimately put on the project. So I talked about dewatering of the pits. This is this really ties into our social acceptability that we have in the community. Together with our Cree partners, we've started dewatering the open pits. So the water that sits in those pits is being pumped out and pumped directly into the environment. It does not need to be treated. It's clean. The pH is neutral. There's no suspended heavy metals. As we get deeper in the pits, it's possible we may have to treat for suspended silt and sediment. But just another proof of concept that this project has social acceptability, that we're, working with our communities to dewater these pits already and pump it directly into the environment. So again, I'll just touch on the path to production. So we are sitting right where that green star is in Q1 of 2025. We are in the final process of finalizing our environmental impact assessment. So that is the document that we file to the federal and provincial government of Canada to ultimately receive our permit to mine. Once that's filed, we expect by the end of the second quarter 2025, we will trigger what we believe to be a 12-month process to receive our full permit. So we expect full permits by the middle of 2026. We see no reason why that will be delayed. I said already we're working on project financing. We hope to have the project financing finalized and secured before the permit, in which case we can get directly into construction following the permits. So end of 2026, start the early works. It's an 18-month build for this project. So we look to pour first gold in 2028 with full production 2029. So look at our capital structure. We're sitting with over 20 million in the bank right now. That's not including a recent investment from Van Eck, who did a $6 million private placement. So in a very strong cash position. We have 65% institutional shareholders of our company, 12% of which are Quebec-based funds, which are tied to the Quebec government. So like I said, we have government support as a shareholder of our company. The government ultimately gives us our permits, and the government will support us going forward.
Hi, Kyle. You may like to wrap up soon, so just a few questions waiting for you to answer.
Perfect. So we're well covered by the street, analyst coverage, and sitting in a great cash position. So one final slide, you can't build a project without an excellent team. We've made four spectacular changes to our management team. Both Andy and Denis are experienced engineers, both Quebecois, both French speaking, have built several multi-billion-dollar projects in the past. The chairman of our board is Chantal Lavoie. He is also Quebecois. He's the former COO of Iron Ore Company Canada, a large-scale company in Canada, and very experienced in building and developing and operating mines in Quebec. So with that, just summarizing, touched on all of these, great jurisdiction, large-scale asset, the team to build it, and upcoming milestones.
Sure, and just in case.
Okay, thank you very much.
Hey, just a few questions here. Let me turn on my camera first. And here, hey, Kyle, just wanted to make sure. Okay, first one question coming from James. So how long will it take to empty the water in the old mine, and about how many percentage will be the copper to gold in terms of the value? Do you know?
Okay, so starting with the dewatering. So we started dewatering in August of this year. We expect the current pit that we're dewatering to take about 8 months total. And then an additional 1.5 years after that to dewater the second pit. So we will be dewatered well ahead of production. On the value is very similar to the breakdown of metals that I showed. So over 80% gold, 15% copper, and a couple percent silver.
Great. And this question from Henry is asking, given the current political environment like the tariffs from US, does it have how much would it impact the mining activities of the region at all?
Yeah, so that's a really good question. We are, as I showed in our financing slide, we are looking to work with the European export credit agencies. We're not tied to the US. The government of Canada has actually announced in support of Canadian mining projects that they are looking to expedite permitting in Canada. We have an election in Canada happening this month, and both leading parties are talking about expediting projects in Canada. They want to support Canadian due to the current political issues. They want to speed up the permitting process. All of these things are positive for mining in Canada. It's a better time than ever I've seen to try and develop a project in the country politically.
Yes, one last question, just one out of time, sorry. Peter is asking, why only half of the 13 million ounce of gold equivalent as included in feasibility study? If the Troilus projects were to be acquired by a company like Newmont or Agnico, could they make the project much larger, like as 500K ounces per year for 20 years?
Yeah, that's a great question. So our mineral reserve takes into account about 7 million ounces of the total 13 million ounces. Those pit designs are optimized at very conservative gold price of 1,500 US. It's about half the current gold price. So if you optimize those, the reserve would get much bigger. You'd encapsulate a lot more of those resource ounces into the mine plan, and you'd be able to operate, at a longer mine life. If a large company acquired this project and wanted to build it bigger, they absolutely could do that. This project could support a 60 or 70,000 ton per day operation. Absolutely.